3 high growth stocks that I'm buying now. I'm super excited to get into this video. We're going to talk about why I'm buying these stocks, what kind of value do I see with them, at what price will I stop buying them, and what my expected return is with each one of these companies. But first, before we get into all that, if you're new here, I'm Austin. I'm a co-owner of cloudbusinessweekly.com. I'm also a stock market investor. If you're new to the channel and you're not one of those 3,900 or so people, go ahead and click that subscribe button and help us get to that goal of 4,000 subscribers and drop a like on the video. It helps out the channel in a massive way. I appreciate you for doing that. Let's jump into the video. So these 3 stocks are not the only stocks I'm buying right now, but they are the stocks I'm buying heaviest right now. Let's jump into it with our first growth stock that I'm buying, and the first stock is Salesforce. This is ticker CRM. This is a $234 billion market cap company, certainly the biggest market cap company on this list here today. Salesforce is the leading CRM company. A CRM software, if you didn't know, is a customer relationship management software focused around sales, customer service, marketing automation, e-commerce, analytics, etc. Salesforce is absolutely the leader in this space with best of breed products in their category. Salesforce is actually my most recent position that I've started in my accounts. And the day I pulled the trigger on opening the position was a day that they had just reported earnings and they missed revenue for the first time in over a decade, and the stock absolutely tumbled more than 20%, and I was like, I can't stay on the sideline anymore. I've got to pick up shares with an average cost basis of $229.55 on Salesforce. So I took advantage of that very narrow revenue miss that clearly turned sentiment for the worse with Salesforce stock. The stock price has recovered massively since that drop all the way down into the 215 range, but regardless, I had to take advantage of it. I had to step in and open that position. Let's check out some valuation metrics and some growth metrics with Salesforce. Before we look at growth and before we look at profitability, we need to check out some valuation metrics. So on pretty much every basis, Salesforce is more expensive than the median stock in their sector, but there is a very large reason for that, and we'll see that inside of the growth and the profitability numbers. It's important to note that Salesforce trades a little bit rich on the PE ratio, trailing 12-month PE 43.62, forward PE about a 40, so a little bit lower forward PE than a trailing 12-month PE, and I believe that forward PE from analyst estimates is actually too high. I think they're going to absolutely crush the EPS numbers over the coming year, and that's going to mean that forward PE number that they've projected is actually too high. Price to sales ratio of a 6.6 is not super crazy when compared to other software companies. Palantir somewhere around a 20, Microsoft at about a 13, and then Adobe at about a 10 price to sales. So Salesforce having a 6.6 price to sales is actually pretty reasonable and arguably undervalued in comparison to a lot of other software names out there. Let's move to the growth metrics for Salesforce. Revenue growth trailing 12 month of 11%. Forward revenue growth is expected to be 9.7%. So either low double digits or high single digits. That's very respectable for as an established company as Salesforce is. But what's really, really amazing is the EPS growth that has happened and the EPS growth that's expected for the next year. GAAP EPS growth on a year-over-year basis was 1,900%. And GAAP EPS growth expected for the next 12 months 223%. That is absolutely ridiculous. Salesforce has stopped being the company that just goes for revenue growth at any cost, and now they are the net income growth and the EPS growth company. What's way better for a stock price is focusing on EPS. Stocks follow earnings over the long term. Salesforce has switched their focus from being a massive revenue growth company. It's still respectable, 9, 10, 11, 12%. That's still very respectable revenue growth, but they flipped their focus to being a net income growth company and an EPS growth company. Since we know that stocks follow earnings over the long term, they're going to keep on growing those EPS numbers quarter in and quarter out for many years to go in the future, and the stock price is going to get very respected as a result of it, because now they can take all that revenue that they get a 76% gross margin on, and if they just run the business very efficiently, we're about to see an absolute massive explosion in their EPS numbers, and that's what analysts are expecting. And I think, like I said earlier, that those expectations are actually too low. I think Salesforce is going to knock it out of the park every single quarter on the EPS numbers. Even if their revenue comes in line or slight misses like it was last quarter, we're going to see disgusting beats on the EPS side, and that is going to mean very good things for Salesforce stock price over the medium and long term. So what price do I like Salesforce at? I like Salesforce anywhere under $250. I really, really like Salesforce anywhere under $225 per share. But if it's under $250, I'm still going to be buying. If we jump above 250, I'll buy light, but I'll still be buying a little bit. If we jump above 275, I'll probably stop buying. That's why I've been buying Salesforce very aggressively recently. I don't think it's going to stay low for long. That 215 that we hit that one day, it popped all the way back into the 230s the very next day. So I think this is a stock that's going to move up very quickly. It might stagnate a little bit in the 250 or 260 range before it makes another leg up again. But over the next 2 to 3 years, I see the stock being in the high 300s or the low 400s as it relates to the stock price. And I think they could do that pretty easily if they stay on the track of keeping the EPS growth as their primary focus. All right, let's get into growth stock number 2 I've been buying heavy. This stock is Hims & Hers Health, which is ticker HIMS on the market. HIMS is establishing themselves as the leader in the telehealth space. They have the best, most user-friendly platform out there, and they're one of the most trusted companies in the entire space. And trust goes a long way for consumer confidence whenever they're buying something as serious as pharmaceutical drugs from a website like Hims & Hers. Trust is absolutely vital. The trust is very, very high with Hims & Hers Health. This company is at a much smaller market cap than our last stock at a $4.47 billion market cap. And the stock price recently has been on an absolute tear. On a 1 month span, the stock's up 71%. On a 6 month span, the stock's up 140%. And then year to date, the stock is up 115%. Needless to say, it's been an absolutely amazing year for Hims shareholders. This is a stock I've been buying for multiple months now with an average cost per share of $14.76, so I already have a 40% gain on these shares. This stock is in the process of flipping the profitability corner. They reported one of their first profitable quarters ever with $11 million of net income in Q1 of 2024. This is just the beginning of the profit numbers. That's nowhere near what we're going to see from this company over the coming years, and I'll show you how I know that in just a little bit. Since the company is currently flipping the profitability corner, the PE numbers look either ridiculously high or they're undeterminable because over the last 12 months, the stock has not made a profit. It actually had a loss on EPS. So the price to earnings numbers are not something we can really look at, but we can look at the price to sales numbers and compare that to the sector. So price to sales on a trailing 12-month basis of 4.74, about 30% higher than the sector, and then price to sales on a forward basis of 3.79, which is only 2% higher than the sector, which is ridiculous whenever we go over to these growth numbers. Check out the revenue growth with Hims & Hers Health. Over the past year, 55.65% revenue growth. That is absolutely ridiculous. Sector median of 7%, that's almost 8 times the revenue growth of their median peer. And then forward revenue growth, they've still got 42% revenue growth expected for the next 12 months. And that's compared to the sector of 8.87%, so much higher, over 4x higher than their median peer. And although those revenue growth numbers look ridiculous, just wait over the next 6 to 12 months to see the EPS growth numbers. The comparables they have are for negative numbers or very, very low EPS numbers like 1 cent, 2 cent. They're about to go absolutely ridiculous on the EPS numbers, and these growth numbers are going to look crazy, like 500%, 1,000% EPS growth, etc. Just wait. I can't wait to watch it happen. To have a company that's growing like this on the revenue side and is flipping the profitability corner at the same time and is trading at similar valuations as their peers is totally ridiculous. For the growth that we've got in this company, it is a insanely undervalued asset, and that's with the stock being up like 140% in the past 6 months. This is an 82% gross margin company, which once again is way higher than the sector that they're playing in, and they're going to be able to use that 82% gross margin and do a little bit of cash management, a little bit of expense management, and these EPS numbers are about to explode while the revenue growth is going to stay in the 40% range. Can't say enough good things about Hims, the best telehealth platform out there, the most trusted brand, the most ridiculous revenue growth that we can find in almost any stock out there, one of the best balance sheets in the entire stock market, and no, I am not exaggerating at all. They have over $105 million in just cash and cash equivalents. That doesn't include the $98 million in short-term investments, the $29 million in inventory, the $29 million in prepaid expenses. Just in cash and cash equivalents, $105 million. Total liabilities, not short-term, not just long-term, but total liabilities, which includes, by the way, $0 of debt. Total liabilities, $103.6 million. So they have more cash on hand than their total liabilities, and they have zero debt on the books, and they're an 82% gross margin company. Absolutely bulletproof balance sheet. I am 0% worried about HIMS at all in any economic time, based on the fact that they've run the company so well with the ridiculous growth they have, the crazy EPS growth we're about to see, and one of the best balance sheets in the entire stock market. This is definitely one of the stocks I'm most proud to be a shareholder of. I like HIMS stock anywhere under 25 bucks. I'll probably keep buying it up into the $30 range, but the higher the stock price goes, the lighter I'm going to buy. Obviously, I'd want to buy on a red day to get a little bit more of a deal rather than a green day, but I'm not going to be too picky around pricing with a generational opportunity like HIMS. If you want to hear about the stocks I'm buying before anybody else, consider joining the Patreon with the first link down there in the description. We'd love to have you in there. All right, and then stock number 3 is not only the smallest market cap company on this list, but it's also the most undervalued stock on this list, and that stock is Upwork. This is ticker UPWK. Stock is sitting at 10 bucks, and that's a $1.43 billion market cap. Over the past 1 month, tough time, down 10%. Over the past 6 months, tough time, down about 24%, and year to date, the stock's down about 25%. Upwork is a freelancer website where either individuals or corporations can go to get freelancer work. Absolutely the best freelance website with the best reputation in the corporate world. Much better reputation than Fiverr, which would be more of like the consumer-based. You and me might go on there to hire someone to do voice acting, resume editing, or something similar to that. But Upwork is more focused around corporate clients, pulling in corporate clients to have them hire these freelancers that are on the Upwork platform. I said this was the most undervalued company on this list, and I meant it. A trailing 12-month PE of a little bit under 15 and a forward PE of about 12. So we love to see that forward PE lower than the trailing PE, which means that the company is going to become more profitable over the next 12 months than they were over the past 12 months. Definitely something we want to see with the stock that we're trying to buy. Enterprise value to sales of a 1.8 with a price to sales of 2.3. Just seeing the EV to sales and the price to sales discrepancy there, that lets me know that the balance sheet is probably in an amazing spot, because clearly the enterprise value is much lower than the market cap based on the comparison between those two metrics. Well, Upwork's growth over the past year was roughly 13%, and they're expected to have about 12% revenue growth in the coming year. Those numbers are about double what we see in the sector, with the PE being lower than what we see in the sector, and the enterprise value to sales and the price to sales being in line with what we see for the sector. So this is definitely an undervalued company when we take the growth rates into account. And just like HIMS, this is a stock that is in the process of flipping that profitability corner. They're a little bit further along in that process, and they're doing it so much faster than analysts expected. If we go back to Q2 of 2023, they were expected to report 0 cents of EPS, and they actually reported 10 cents of EPS. And then the very next quarter after that, they were expected to report 10 cents. They actually reported 21 cents of EPS, over a double up of the expectation. And then the next 2 quarters after that, they beat by very respectable numbers, beating by 15% in Q4 of 2023, and then beating by about 18% in Q1 of 2024. With about a 76% gross margin and a clear focus on growing those net income numbers massively, and the fact that the stock is undervalued or in line, depending on what metric you're looking at, in relation to its peers, and the revenue growth is over 2x of their peers, this stock is a screaming buy right now. I really like Upwork anywhere under $15. The stock is well under $15 at about $10 and some change, and I'll probably keep buying Upwork past $17.50 and maybe even higher than that. And once again, if it goes higher, I'll buy a little bit lighter. The lower it goes, the heavier I'm going to buy. Definitely below 15 is a heavy buy for me. I see Upwork being somewhere solidly between $20 and $25 a share 2 to 3 years from now, assuming they can keep this EPS growth going. Let me know what you think about these 3 stocks. Are you putting these stocks on your watch list? Are you staying away from these stocks? Do you already own these? Are you also buying these? And what other stocks do you think I should look into? What great growth opportunities or value opportunities or dividend opportunities do you see out there that you want to put other people onto? Let me know. I love hearing your comments. I love hearing about all different types of stocks. And actually, a watcher of the channel put me onto HIMS stock many months ago, so I appreciate that person in a massive way. If you have any of those types of stocks that you think are transformational opportunities or just great value, let me know in the comments below. Let's get some conversation going on down there. I appreciate you being here in a major way. Thanks so much. Have an amazing day.